Welcome back to another presentation. I've been wanting to do this presentation about 10 months now. I was at Uruguay um, in a Latin American config conference, LABITCONF. Um, it's a yearly conference that they have. This happens to be in Uruguay, and I decided to present, or they asked me to present digital currencies in central banking. Uh, the Sputnik moment, and the whole idea here is that in terms of central banking, blockchain technology, and especially the design specifically for central bank digital currencies has spurred this innovation, or moving into this new world, or new area of innovation. So hope you enjoy the presentation. Um, Let's get started. The agenda, we'll talk about digital payments, why CBDC as a digital payment is so important, and why are most banks the central banks are looking at this. We're going to look at smart point of sales, or smart point of sales that merchants currently have, and one of the new ones, because you currently have point of sale, but the new types of smart POSs out there. So we'll look at that because it's a very integral part of this solution. We're going to look at the benefits of digital payments and why the whole idea of having digital payments. We're going to also talk about why blockchain, or distributed ledger technology as well, why it is such a revolution in terms of innovation. And that doesn't solve all aspects of technology, but it does a big aspect of a challenge that we've had for years. We're also going to see the difference between permissionless and permissioned blockchain, the difference between these two, because it's a very important misconception when you mention blockchain and you bundle them into one category. But indeed, depending on the design, you can have two different types. We're going to look at an example of a migration path that I see that it's a potential option for central banks and commercial banks to move towards this innovation. We're going to look at basic use case, just go through the steps of that. We're also going to look at where the innovation is moving forward, and some examples in initiatives around the world on CBDC. So the first, why do we want CBDC? Why do we have digital payments? Is you have users at the moment have a mobile phone, mobile device, and this mobile device, it's an agent for these individuals, users, consumers, entities, to provide wealth of information for both taxes, merchants, and bank institutions, financial institutions. In terms of taxes, the tax payments and transactions data are automatically paid to the tax authority. So the tax authority at the moment has a real-time view of how taxes are being collected. So it's a wealth of information for the government, because they now see where the weaknesses are in terms of payments, where the strengths, and it helps the plannings and the projections and the roadmaps for countries, and the way of justice. So the idea here is that you get real-time data, which we don't have at the moment. Merchants, on the other hand, immediately receive payment. So they provide services and they receive payment. So that happens immediately at the point of sale. And finally, the banks themselves, both data records about the transactions are automatically submitted to the banks and to the merchant banks, and to the customer banks. So both merchant and customer will get real-time information about their transactions and how their behaviors are. So that also helps the banks project in terms of vision or roadmap for their own business case in terms of a financial institution, how to project and better sell their products and services. So smart POSs, basically it's a device, as you can see here, It looks like a smartphone that you hold in your hand. It just has more hardware around it, and we'll talk about all these right now. But basically, it's just a smartphone. So there's no we're not reinventing the wheel. There's not proprietary software or hardware. You basically install applications in this, just like we install smart applications in our phones, but with more things. One of the things that you get out of this smart POS is again, direct tax collection. You also get direct reporting to the central bank as well, because the central bank will have, in other words, APIs or application program interfaces that from this device will talk to the central bank and to other banks, institutions, or financial institutions. You have direct reporting to the government as well. Same idea here. You could have multiple settlements per transaction, so each transaction can settle at different, either where is the central bank or to a commercial bank or to another type of distributed database. All these, the actual settlement happens on multiple, let's say multiple distributed ledgers or multiple blockchains from this device. The device itself has the typical credit debit card IC readers, so that doesn't change. It's still the same. You got real-time sales monitoring for the merchant side. All that is centralized in one device or one database that the merchant controls, and they're able to see that information in real time, help them project better the products and services. It's an all-in-one terminal with QR code, scanner, NFC that goes into just what we have today. So that also doesn't change. It's customizable, so it's a white label, so you put your own brand into this device and service. It's portable, obviously anybody can carry it around. In terms of banking, one of the biggest challenges for financial institutions is to maintain compliance, know your customer, and anti-money laundering techniques and systems, AML systems. These devices provide that. You'll have a camera, you can have a scanner, you got a fingerprint, you got a lot of things to aid in these type of challenges. It also provides significant benefit to the economy. These type of solutions. First of all, it provides a free movement of capital. Why is a free movement? Because you're able to maintain, let's say you maintain a wallet with CBDCs or in this case, local national currencies, and these local national currencies, when you travel or you decide to move the country or go to another place, you could do it a lot easier, a lot faster, with much more security, by selling your local currency and exchanging it to the new currency that you're moving into, for example. Vice versa, if an external entity wanted to come into the country with the legal process, they could basically use the same system to purchase the local currency to conduct local economy. So it's the free movement of capital accelerates, basically, becomes faster. And when you say free movement, it doesn't mean that there's no taxes involved, there's no controls involved. There is control, there is taxes. I mean, that's the whole idea of this system, is that nothing changes the current. It just makes it more effective, efficient, and secure, and faster. By this, I mean reduction of cost, the transaction and cost. So by transactions, you lower my cost, whether I have to involve third parties or not in this situation. Your transaction costs will be reduced. So that's also a benefit for the user and for the country as a whole. Faster transactions, we talked about that. And it's a digital decentralized finance network, what they call the DeFi, or fintech. This is also mixed with CeFi, or centralized fintech as well. But the idea here is that it introduces individuals to have control of their own finances. And their own money and their own, or their own fiat themselves. So this also introduces this idea that you're including individuals into this network, which leads me to the next point, which is improved financial inclusion. That's the key. Because of these tools are available to the individuals now don't need to go to a third party. Don't need to go to a third party financial services to engage in these services. You could be included into this economy without having to go to these hoops and challenges that the banking system currently has. So why do we look to blockchain for solving this? Why would blockchain solve this problem? Because of the redundancy, and this is where the word distributed ledger technology means. Ledger meaning some kind of database is distributed, and it's a technology that it's based. Why blockchain? Because blockchain was the very first one that was proven to work, and it was done with Bitcoin, because Bitcoin was one of the first tokens that were decentralized in this type of ledger. And it proved the whole idea that you can exchange value from one individual to another without having to use a third party. And this is exactly what the technology proves. So that now the design of this is where it changes, and we'll talk about that a little bit later. It also reduces the overhead costs. Because it's programmable money with distributed consensus, in other words, smart contracts, it reduces the cost. Now, because I don't have to include that third party, I can improve my services, reduce my cost, reduce my for example, my resources to maintain these type of solutions in a centralized way. It's much more costly than in a decentralized or distributed way. There's also accountability, transparency, and embedded inherent into this DLT or distributed ledger. It's censorship resistant, meaning that in the past, if you had a database and the database administrator was corrupted or was instructed by some kind of fraud or situation, that could have been done. In a DLT, distributed ledger, depending on the design, censorship resistance can be applied very easily, and the accountability and transparency is there by default. You could, by design, make it so that it's not as transparent, but with the proper design, you can make it very easily transparent to the parties that are involved, basically. In the case of CBDC, the parties that are involved is the whole country, so it's important to make sure that at least that option is there. Persistent immutability basically means, again, part of that transparency is that if you input information into this distributed ledger, or you take information out, once you write it in, it's completely auditable, because you can't go back and remove a transaction. Now, depending on the design, you could have that possibility. So it's just a matter of how do you program and design the ledger. In the case of the CBDC, if those coins have to be changed, or if those transactions have to be reversed because the society decides to do that, that is in the design. You can have that from the very beginning. So it's not like some patching or something afterwards. But by default, it's immutability by default, meaning that it's anything you write into it, it stays there forever, and for the longevity of the ledger. And obviously, security is extremely important, because that security is the core of a distributor. Using cryptography as its foundation, then security is just the outcome. Very easy to secure and maintain a secure, reliable database, basically. So now we see the two types: permissionless and permission blockchain. So permissionless, it's basically there's no third party, which means that you can participate into the blockchain without any, asking any permission or any authorization. You could participate in this blockchain. So that's what Bitcoin is. It's a type of permissionless database in which you go in, but you can't go in there either and try to remove stuff. So it's like you write something into it, and you exchange, in this case, Bitcoins, value of Bitcoin. That's why it's called permissionless. You don't need permission to actually execute. The other type, which is the design where CBDC would fall into, is permissioned or a federation blockchain, which basically means that you have a federated, or you have a board of banks or member banks. So it's a club that allows for the consensus and the governance to be built just like we have right now. So there's no difference from the central bank's design that we have right now, in which countries negotiate and do their swaps and all these negotiate between countries, and they exchange their currencies. All these things are built right now and designed, so that same functionality will port into the blockchain design, which makes it into a permission or federated or federation blockchain. This table depicts more or less the types of blockchains. So, for example, we have permissionless blockchain, which is Bitcoin on the left, and permission blockchain on the right. And so you have, for example, permissionless blockchain says there's no oppression, says resistance. You can't really turn it off. Let's put it that way. Immutability, there's no fraud. You can't go back and change transactions, or if something horribly bad goes, you have to live with it basically, because once you write it to the database, it's completely there. You can't remove it. Because of that, there's no cheating, and there's accountability. Whoever loses loses, whoever wins wins. It's free market that decides. It's a very suitable design for free markets. It's transparent. Obviously, you see all the transactions. That's what they call it, a pseudonymous kind of identity that you have on the blockchain. You have openness, no barriers. In other words, Bitcoin itself allows you to move from one entity to another. By the way, the ones in green are specifically to Bitcoin. The ones in white also share the same, more or less, could share the same in permission blockchains. Openness, no barriers. Global, no borders. Trustless, no laws or law. Basically, you trust mathematics is the key here. There's no, you don't have to trust a third party, but you have to trust mathematics or science. Deflation, no inflation. Scarcity, basically is the name of the game. There's 21 million Bitcoins, so in this case, Bitcoin specific. And you have decentralization or no centralization, basically. Now, on the side of the permission blockchain, you have censor resistance is outside the federation, so anybody who's outside the club is censored, basically, or cannot censor the club. Let's put it that way. So if you're in the club, you might be able to manipulate the availability of the blockchain. If you're outside the club, you can't. Immutability is no fraud. Only the strong has the federation. So if the federation has flaws, then the blockchain has flaws. That's basically what it boils down to. But we have the same mechanisms in the 20th century that we've been using that works the same way. Accountability, again, the regulated federation provides accountability. Transparency up to the federation. Openness, it's permitted. Who can come into the club. If there's a new country that doesn't behave good, it gets expelled out of the club, let's put it that way, or it can be included into the club or the federation. Globally, based on regulations, it could be stipulated by the federation. Federation can design the permission blockchain into that. It can only be functioning in certain jurisdictions. So it's also tailored to that. It's not no borders. There are borders that could be designed into the solution. Centralized. This is very important because it's complete central control. That federation has control over its participation in the club. So that's something that's completely different to the permissionless. Inflationary, it's up to the government to decide how they're going to inflate the monetary supply. So again, this is stipulated by the federation, and you can enforce civilian rule of law, the law of the land, the law of the country, the law of the region, etc. Now, what is a potential migration path that could be executed here. And this is just an example. One of the first steps you could do is, make sure there's open banking. So the use of, that's a misspelling there. The use of API or application program interface. This is important, especially in fintech. In Europe, Asia, North America, South America, and Central America, they all use heavily API to interact between their applications and different third parties and different other institutions. If open banking is not in place, or is not, it's a longer road moving forward into CBDCs. So open banking is very well suggested. Make sure that countries have an open banking kind of implementation, and if they don't, they're probably working already on that. And this is their new technology, the new innovation they're presenting at the moment for the customers. Obviously, the next path would be the CBDC part. So the idea here is that it would replace, for example, we could start with SWIFT. Could be replaced or augmented by CBDC. So you would have SWIFT running as it currently is, and you have CBDC incorporated into a blockchain federated technology or innovation or solution in which it will augment. So the transaction can go either way, depending on which, obviously if it's a SWIFT transaction, the only way to get to the other side or make that transaction, then you wouldn't use CBDC. But if CBDC could be used, then the security increases, the cost of transaction, the speed, etc. It's all the benefits. So it's like when the invention of the fax, all the faxes were going through the fax machine, but eventually when people started using email, then less and less faxes were being sent through the fax machine and more email was being used. Second step is you then go. This is that was the first step. Was the international part. Second step would be to replace or augment the ACH or SEPA or TGS systems that are currently in place. So now you're using the same innovation, same technology, but for your local and national financial market. So in the country's financial infrastructure. The same exact thing. When a transaction needs to go from one bank to another bank locally, it could go through the ACH system or it could go through the CBDC system, depending on how it's deployed. And the third step is you hand over the responsibility to distribute the new CBDC fiat currency. Different ways of designing this. You could have the commercial banks, just like they do now. You give them the currency. The central bank creates the currency or maintains it or manages the currency. The local currency, and gives it to the fiat local currency and gives it to the bank for the bank to distribute. So they have a kind of an account base. So you would do the same thing with the CBDC. You distribute the coins, or they take ownership of the distribution of that currency. But the key here is that countries are taking a very cautious, conservative move. So they're moving much, and I mean this is 10 months in the making. You see a lot of new initiatives coming out. So what does it solve? Basically, it solves the digital currencies right now. At the moment, they're basically SQL currencies. When they say, well, we have a peer-to-peer payment in which you have a phone and you make payments at local merchants. Or you have a debit card, and immediately you can pay from your phone or from debit card into somebody else, etc. They're not peer-to-peer. They're actually batched over into a centralized system, and they could do this very quickly. I'm talking about seconds. These transactions could happen, but they're SQL currencies as a differentiation, because that centralized database, account base, where the account lives, it's not on your phone, it's not on some distributed ledger, it's on a centralized SQL database. And this database could be distributed as well, but it's a very costly, could be in the cloud and distributed throughout AWS or Azure, or Microsoft Azure, and all these, but they incur a specific cost. Obviously, with API open databases or open banking, you improve this type of account based type of thing. But again, it's an SQL currencies, what I call it. And this gets replaced with the CBDC, because now when you put the CBDC, the redundancy, you don't have to maintain it. It can be redundant by on itself. On top of that, you put encryption as its core. That's another one that goes by default. You don't have to have these centralized databases that have to be protected. But what they will not be, and this is something that we have to point out, they're not open, meaning that it's a federation, it's a club, so you have to join the club, which is exactly what central banks are looking for. They're not public, same again there, it's not like anybody can come in and you have to treat it like a national currency. It's not borderless. You have to exchange currency for another currency, just like we do now. It's not neutral, so you could have a political party coming in and taking over, just like they do in Venezuela. Venezuela already has a type of a CBDC, but they have total control, and that's how the politics go through. So it's not neutral. It's either pick a side. But hopefully, democracies, most of the countries that will inherit this, will use democracy, the rule of law, and make a fair, balanced, neutral kind of system. It's not censorship resistant. So just like you see in China implementing the CBDCs, they'll have more control over the public. But again, this is exactly what governments are looking for. This is exactly what central banks are looking for. Is the ability to not be censorship resistant. You want to be able to censor people that you don't like, or politically, or at least the whole community doesn't like. That's the whole idea. We live in a government. Doesn't mean that I agree completely, and that's why we have democracies. That's why we have the ability to vote in and out, representatives. It's not immutable, because again, that nation that you can make it immutable, but if you have to change things in the ledger, let's say erase the past, it doesn't stop the federation from doing that. If the federation decides to do that, they can go ahead and do that. This is an example of I've done this. I've presented this before, but it's a very simple. You have on one corner over here, you have country A, and on this other square you have country B. And they have users, and they do KYC, AML with their own banks. So you have 3 banks in this case. Each user has his own bank. Now the banks, their member banks will have their own, let's say, local digital currency, or DLT, smart contract kind of thing, running in the background between the central bank and the commercial. This is where that currency gets distributed. They give permission, and then again, this is the local national club. Let's put it that way. And these coins get exchanged. So they'll have a smartphone that they could purchase from this merchant, and so on and so forth. In terms of the central banks themselves, they'll have a connection to, again, some kind of blockchain technology or distributed ledger, where again the members are the central banks. So obviously by inheritance, kind of like this bank belong to that membership by default, because they behave well, right? They're part of that regulated entity. And in country A over here, you got the same result. So the idea here is that if Alice wants to purchase some kind of merchandise, let's say this is a hardware store from Bob, then Alice just goes to his website, makes the order, and then Bob says, okay, you can pay me with my digital currency in country B, right? Obviously, the Alice will see that that website is a country B, will have this smart contract activated in real time, basically, literally, which basically establishes the swap between these 2 countries that's already established. And because you have that swap, it can dictate that pricing at real time, basically utilizing that conversion swap. So in other words, between the 2 countries, there's a conversion. So now Alice will be able to see the cost in her national currency, what it would cost her to purchase this from country B. So that's also in real time, and obviously if user in country B is buying from country, from this user, then it's the same currency. There's no swap involved. So these smart contracts are not activated, basically. And that's basically what it would work. She would see it in her local currency, make the payment. The transaction happens between the user basically depositing, making that transaction, creating this smart contract to activate, and the whole exchange of tokens happens in the background using blockchain technology. And instantaneously, basically in real time, Bob will realize that they have their coins, or they've received those coins, because it's almost like a real time peer-to-peer exchange between Alice and Bob, because the swap happens in the back. They don't see it, and it's just a matter of Bob just shipping that to Alice. That's basically how transaction works. This is a very simple explanation of how blockchain technology could be applied for CBDC purposes. So where is this innovation moving? Central bank digital currencies are more and more, you hear the word CBDCs, different countries doing it, but you also hear the words stable coins, and these are commercial financial institutions that are tying are creating this token and tying it one-to-one to their local currencies or to a stable currency. In this case, most of them, they do it to the dollar. So these are well-established organizations that are actually doing what the CBDCs are doing. So that's happening a lot in the U.S. And there's Tether, which is another company that or institution that has reserves in terms of dollars equal to the amount of stable coin. In other words, the tethers that they provide out there to the public and to the network. Heavily regulated, et cetera, et cetera. So this is the gradual movement toward either CBDCs or stable coins. In Latin America, one of the biggest catalysts would be Libra, but that's 10 months ago. Libra has gone through a lot of roadblocks, but looking at 2.4 billion users and growing, you have a very big community. In China, you have the same idea with WeChat. So Latin America is poised to realize, hey, Libra is a big thing. It's being regulated, or it's being challenged in the courts, and being challenged in the governments are challenging it, which basically feeds into the CBDCs and stable coins more and more. Or that change. So around the world, we have the BIS, or Bank of International Settlements. They're looking at this, the future of money and the payment system. You have the ECCB, which is a basket, which is headquarters in St. Kitts, Nevis. The ECCB has been it being designed and implemented by BIT, a company in Barbados. EU won't let stablecoins enter the market, but that's also changing. This is because of the regulatory environments. You see America also passing certain regulations in Congress about regulating currencies. Japan is considering, and I think at the moment is implementing some kind of CBDC. British Virgin Islands has their own digital currencies. The BRICS are looking into type of creating a new crypto for the unified conglomerate of the BRICS. The IMF, it's providing advice or design for central bank digital currency. So you see throughout the world, and you just look up any of these initiatives out there. And these are 10 months back then. Now there's even more of these type of things. So finally, just to close, it's the view that I see is the CBDC will be under legal tender status. The idea here is that CBDC will be under legal tender status. So in other words, if you want to participate in the economy of that local country, you will be using CBDCs to make those transactions. But at the same time, your wallet will have two different balances. For example, CBDC, US dollar, Barbados dollar, or Trinidad dollars, and you'll be able to exchange back and forth between them. And at the same time, you'll be charged fees, obviously, but you will also have other third parties that will facilitate liquidity for these type of exchanges to go through. But again, a lot lower cost, much more efficient. So future CBDCs looks bright. It's just an update. It's been 10 months, so I wanted to make an update of the presentation. Hope you enjoyed it. If you like the video, just like at the bottom, subscribe to my channel, and I'll be hopefully making more of these in the near future. Thank you.